What if I told you there was one simple metric that the best investors in the world use to predict where risk assets are likely to go? Well, in today's video, that's exactly what we're going to dive into. We're going to break down what is this metric, how can we use it, and what does it tell us? If you're excited to become a better investor, like and subscribe down below, and let's jump in to today's video. So what is this simple metric? It's none other than the DXY, or the dollar index, which simply tells us how strong the US dollar is. Since the US dollar is the global reserve currency, whether or not it goes up or down has implications for the basket of other currencies that are weighted against it. If the dollar goes higher, other currencies become worth less, and this actually drains global liquidity. Even though no currency units are coming out of circulation, those currency units are losing value. This happens through a number of mechanisms. Let's break down some of the simpler ones to give you an idea. So have a look on your screen. We've got some of the transmission channels here, how this happens. Global trade in commodities. Most trade is invoiced in US dollars, so a stronger dollar raises import costs. Weaker demand for imports, less global cash flow. We have a central bank reserves. As the dollar rises, it lowers the FX reserves or the currency reserves of emerging markets. They intervene to stabilize local currency. So if I'm a tourist and I go to Uzbekistan and I have 100 US dollars, I'm going to get a whole bunch of Uzbekistan, whatever their currency is in Uzbekistan, crazy example. They're going to have to exchange a lot of their currency for my dollars. What their central bank will do is it will print money and take those dollars out. Is that we'll take those dollars off your hands, go ahead and take more of this currency. That weakens their currency. Because remember, when you print your own money, you make it more abundant. You make it worth less. Think about Charizard cards. If we found a 10,000 mint condition first edition Charizard cards, what would happen to the price of the ones that are on eBay? It would go down. Same thing with currency units around the world. So when a tourist visits Uzbekistan and they put all that money in, their central bank has to weaken their currency as a result. And so that's why a high dollar is essentially quantitative tightening for the world. We've got financial conditions. And so a stronger dollar correlates with tighter financial conditions. And on this channel, we've talked about the connection between financial conditions and the business cycle, something that's very important if we want to see an alt season. And then crypto and altcoins, crypto priced in USD. A stronger dollar reduces speculative appetite and global liquidity for the reasons we mentioned. It's a risk asset downturn. And so essentially what we're getting at here is that the dollar, through a number of mechanisms, draws down global liquidity. Think back to the beginning of the year. I got a chart here from Raoul Paul, Julian Biddle over at Real Vision. Remember what happened at the beginning of this year, at the beginning of 2025? We saw asset markets absolutely tank. At the same time, we saw the DXY spiking higher. This is the same thing that happened in the 2016, 2017 cycle as well. However, a few months later, we saw the dollar fall sharply. What did asset prices do around April or May? They recovered. Bitcoin, Ethereum, Solana, they all went higher. There's a connection between the DXY and asset prices. Let me put it to you more directly. Over here on TradingView, we've got US dollar index in white. We've got others in green, kind of backwards. But you can see that as the dollar index goes higher, the others or altcoins stay low. As the DXY falls, altcoins go higher. As the dollar goes lower, altcoins go higher. As the dollar goes higher, altcoins go lower. And so what we've seen, if you zoom on in there, is recently we've actually seen an uptick in the DXY. And this could actually explain, it does actually explain some of the price action we've seen over the last couple of months. And you can see that as the dollar goes higher, we came up from the lows of about 96 and change up to almost 100. We want to keep it below 100. We saw altcoins fall. We saw Bitcoin fall because think back to those mechanisms. We're draining global liquidity. We're draining the amount of money in the global financial system. We're reducing the appetite for economic activity, and therefore asset prices will fall. That's the connection. And in fact, this is the golden question. How can we predict the DXY? There's a number of ways, and some of it's pretty technical. I'll give you a freebie. If the Fed is planning to tighten monetary conditions, monetary policy, then that means that the dollar is going to go higher. On the flip, if the Fed plans to ease, end quantitative tightening, or dare I say, run some sort of QE policy, the dollar will weaken. So let's have a look. Fed tightens while other currencies are easier. Capital flows into USD assets. Dollar gets stronger. Boo, we don't want that. The Fed eases rate cuts. What have we been seeing? We've been seeing rate cuts. The Fed is likely to do a rate cut in December. I'll do a video on that soon, why I think the Fed's going to cut rates again in December, cutting rates, doing quantitative easing, or at least ending QT, which they're doing in December. They've announced that. Capital flows out of the US. The DXY goes lower. So this is very bullish. This is good to know. The Fed is ending QT. The Fed is in a rate cutting cycle. President Trump very likely to appoint a very dovish Fed chair in May, likely to cut rates, likely to run some sort of QE policy. What is the DXY likely to do? Subsequently, what are altcoins likely to do? I don't know. Have a look at this chart. You tell me. If DXY goes down, altcoins go higher. What's likely to happen? Obviously, that's rhetorical. Altcoins are likely to go much higher. Bitcoin is likely to go higher. Ethereum, you name it, is likely to go higher. So, now that we know this, I hope this makes sense to you. I want to show you a clip from none other than Kevin Hinks over at Schwab. I'm going to break this down, put it in his own terms. I hope you find it helpful. Have a listen.
Matter of fact, the lower dollar is what's adding to the gold rally that we're seeing right now, and a rally in the metals. Remember, lower dollar is a tailwind for commodities, metals, a lot of things like that. So not to mention U.S. multinationals whose goods get less expensive for foreign buyers. So a U.S. dollar, though it feels unpatriotic to say that you want a lower U.S. dollar, in many ways, Nicole, it's better for many parts of the U.S. economy.
And so there you have it. It's better for many parts of the U.S. economy. Cheaper exporting and importing, less currency debasement, and more global liquidity, which, as we know, is a very bullish thing. And even more bullishly, based on what we know, the dollar is likely to continue to fall. When Trump had the Mar-a-Lago Accord, the dollar fell shortly after. Typically, and I'll give you another freebie, when you hear any kind of accord, whenever leaders of countries are getting together and they're going to do some kind of an accord, typically that means the dollar's going to fall. If you look back through history, any kind of accord, typically the dollar's going to come lower shortly after. So I hope this made sense to you. I hope this is helpful for you. I hope this gives you one more tool in your investing arsenal to keep an eye out and become a better investor and a more successful investor. And of course, that's the goal of this channel. If you enjoyed today's video, like and subscribe down below. Leave me a comment. Let me know what you think the dollar is going to do. Let me know what video I should do next. What do you want to learn? Until then, thank you for being here, and we'll see you in the next video.